welcome to your Monday Futures Market Outlook for December 13th, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. We're looking for a consolidation into the summer, and we were at that stage looking at the possibility that there could actually be another full leg lower, but we were saying that so long as the bulls contain all selling at the 1,000 level or so on the S&P, that would open the window for another full leg higher up towards the 1,300 and 1,350 areas on the S&P. At this stage, we continue to stand by that outlook. We still continue to forecast 1,300, 1,350 on the upside, probably within the first quarter of next year. More than likely, come January, there probably will be one profit-taking cycle downwards before completing the moves higher. So we're not looking for a straight line move, but nonetheless, the trend is distinctly higher at this stage. Next here, I want to take a look at the S&P 500 on the daily charts. When I want to zoom in on this, and we were talking about this consolidation of 5% market profit-taking cycle that finds support and eventually continues to rally. At this stage, we've now broken out to new highs, and the S&P is well underway of moving on the upside. And this is bullish. We are seeing at least a shortened move that we're targeting this 1240 to 1248 zone right in here. We think that at some stage here we should stall in this price action, but even if we stall here and have a little bit of profit taking, more than likely it will find support and turn up to finish the moves on the upside towards the 1260, 1300 level on the upside on this move. The only circumstance which would have us change our outlook in any way would be if there was any significant technical damage done below the 1200 level, that middle red line in there. If we started getting down below there, we would start to visit the idea that there could be some alternate scenarios coming in, but at this stage there's no reason to believe that that will happen. Just to review our key points, we maintain our intermediate bullish bias. We say a bullish bias because we don't believe that this is actually a new bull market, simply a bullish uptrend that must be respected. We think that it can more than likely continue on even into the second quarter of next year. It is a diminishing probability that we'll have any negative reversals in December. There usually needs to be some sort of a catalyst that drives an immediate market reversal when there's this kind of momentum going. Really at this stage, more than likely beyond a couple of down days, December should be relatively boring. Now there is a momentum loss and a lack of market breadth, but we've seen this kind of conditions prolonged for extended periods. So just because we're seeing that on the indicators doesn't mean that everyone should be immediately concerned, especially into the traditional December month where things slow down. You'll naturally see those indicators doing so. The real next window of risk really does come into the earnings season in the new year. So that's probably where we'll see the first really good pullback again of this on these markets. But in the end, it's going to take a pretty big catalyst to shift the entire momentum of the market. So we continue to still look for potential rallies into the first quarter of next year, even if there is an earnings season pullback. Next year, I want to take a look at the NASDAQ 100, and we similarly have seen a break to higher highs on the NASDAQ. We're looking for continued follow through here. Our first target is the 2250, but there are some upside moves that even go as high as the 2320 area on the upside. That blue box marks off the zone where we're expecting the NASDAQ to maintain its path up towards those upside targets. Next year, I want to take a look at the U.S. dollar index futures, and more or less the U.S. dollar has sort of been consolidating over the last 2 weeks while the market has made its advance. And this is one of the reasons why the market is only inching away higher, because it's not being driven by a natural boost from the U.S. dollar. But if the U.S. dollar here continues to do the kind of sideways to lower consolidation, we could see it roll down and head right back down to that 79 or 78 level. That would actually just be even a consolidation in the dollar index, not a new leg lower. And if that's the case, then the markets should spur higher on this consolidation. But it would certainly make us concerned about January in terms of if another leg higher in the U.S. dollar come the first few weeks of January could really spur on a profit-taking cycle from there. So we'll be watching how this consolidation lower pans out. Next, I want to take a look at gold futures, and gold futures continue to be sort of doing this diagonal wedge higher in the last 2 months, ever since October, November, and these swings higher and lower. They've sort of been progressively inching in uptrend distinctly, but at the same time, there's no more meat on the bone as there's a distinct momentum loss. At this stage, though, we certainly cannot rule out the possibility that gold even breaks to a higher high, as it maybe makes a push even towards the 1450 area. But if we have any legitimate break of this trend on the downside, a break below 1380, and especially if it makes it all the way back down to 1320, 1330, then we'll see a number of different topping formations starting to potentially develop on gold futures here. Bigger picture, we still believe that gold should go through some sort of a multi-month corrective pattern. It doesn't. The very big picture, weekly and monthly trends should not be violated, but the daily charts should go through a proper correction. Next here, I want to take a look at crude oil, and crude oil is in a distinct uptrend, and the measured moves on the upside of crude even go as high as the 94 to 96 zone. If this last week's consolidation holding above the 87, 88 zone, and particularly Friday's reversal candle, if crude oil here is in any way maintains this bullishness and the way it's consolidating, we should have a breakout on the upside. And particularly if we have any breaks above the 90-91 right into that green box up there, we should see follow through that could potentially make it even as high as that 94-96 zone on the upside. The only way that crude oil becomes more neutral to negative is if we make it all the way back down to the 83-84 zone. That would distinctly mean that the momentum that was been in place over the last month is stalling. Finally, I want to take a look at the 10-year Treasury notes, and both the 10-year and 30-year Treasury bonds continue to very rapidly decline as there's interest rate pressure occurring on those bonds. At this stage, there's an important support line at this 1920 area on the downside. And more or less as we bounce off this 119, 120 area, we'll be trying to look for important cues, because if in the bigger picture we break through that zone, there really isn't much support until the major lows that all came in around the 115, 116 area. So we'll be watching how the support line plays in here. If we get any sort of a bounce, like a flag or a wedge that fails to make any legitimate progress, it may actually open the window for a new shorting opportunity on the 10-year Treasury note. That was your Monday Futures Market Outlook. Thank you for joining me.